Welcome to the Stock Health series. In this series we are going to look at certain parameters and get to the final health score of the stock requested by you in the comments section. Today's stock is Reliance, which was requested by one of our amazing subscriber. It has a market cap around 19 lakh crores and stock price around 1400. Reliance has diversified itself in many major businesses. Estimated growth rates for businesses are as follows. Its estimated market CAGR comes around 7.5% annually. So we have a business model score of 7 out of possible 10. In case of liquidity, let's look at these three parameters. Debt to equity is long-term plus short-term borrowing divided by equity, which in this case comes 0.41, which is good as it's less than 1. Debt to equity is good when it is low, which is quite good in this case. Interest coverage is earnings before interest and taxes divided by the interest portion. In the case of Reliance, it is 5.36. It should be higher than 1, which is high here. Let's see current ratio. Current ratio is current asset divided by current liability. In this case, it is 1.1, which is not that great as it is close to 1. So we have a liquidity score of 4 out of 5. For activity score, let's look at the cash conversion cycle, which explains a lot about cash and product management simultaneously. In cash cycle, cash goes out to the supplier, who provides raw material to the company. Raw materials are processed to the final product, which sits on the company's inventory. The product is then passed on to the customer on credit or on an instant cash basis, which is then received back to the company. Ideal time to complete this cycle is -30 to 180 days. You will get to know about this in a moment. Cash conversion cycle is days of sales plus days of inventory minus days of payables. Days of sales is time required by customers to pay. Days of inventory is time taken by products sitting on inventory. And days of payables is time taken by company to pay to its suppliers. Days of sales is receivables by revenue multiplied by 365. Days of inventory is inventory divided by cost of goods sold multiplied by 365. And days of payables is payables by purchases multiplied by 365. After calculating this for Reliance, we get 16, 126 and 164 respectively. Ideal values are mentioned on right side. Inventory's best figure depends on industry and product. So the cash conversion cycle for Reliance is -22 days. Though their payables look a little high, they are in a cash cycle surplus, which is great, so we have an activity score of 8 out of 10. For profitability score, we will be looking at NPM, ROCE and ROE to see the efficiency of the company to generate profits out of current available capital and assets. Net profit margin is final profit divided by revenue. In case of Reliance, it is 8.37% this year. Return on capital employed is calculated by profit before interest and taxes divided by total assets minus short-term liability. Here it is 8.7%. Return on equity is profit minus minority interest divided by equity. Minority interest is taken into consideration as the portion is not too small for Reliance. So, it is 8.25% in this case. Considering the last 5-year data for all of the above ratios, Reliance gets a profitability score of 3 out of 5. In terms of governance, promoter holding and pledge percentage are very important. Here, promoter holding is around 51% and there are no shares pledged. So in case of governance, Reliance gets 7 out of possible 10. In statistics, a metric called standard deviation is used to figure out how stable or consistent the values are. Lower values of standard deviation symbolizes most stability. In this case, we will be running standard deviation on last 5 years' data of NPM and ROCE, which come out 1.04 and 0.9 respectively. So, Reliance gets a complete 5 out of 5 in stability. In Miscellaneous Score, we will be looking for other pros and cons of the company. In Reliance's case, all the valuation metrics are simultaneously low, which is a good thing. But they have high goodwill value and balance sheet, which is 60% of its total intangibles. Their dividend yield is also low. So we have a miscellaneous score of 7 out of 10. Revenue growth of Reliance in terms of compound annual growth rate for the last 3, 5, and 7 years is consistent around 10 to 12%, which is quite good. The estimated growth for revenue for the next 5 years is around 9%, which is pretty decent. So the growth score comes 12 out of possible 15. Price to sales is a good ratio to find cheaper stocks quickly. Generally, cheaper stocks have PS lower than 5. It's calculated as market cap divided by revenue. In our case, it is 1.95, which is great. Proper market value is calculated by justified earnings multiplied by adjusted PE. In Reliance's case, justified earning is 94,020 crore, which is multiplied to the adjusted PE according to 9% growth, which is 29. So we get the proper value as 27,26,000 crores, which is higher to its actual value, which proves the stock is undervalued by roughly 44%. By estimating future value using CAGR, NPM, and PE, we get a forecasted value of 33,55,000, which is approximately 78% possible returns in next 5 years. Hence we reach at a score of 22 out of possible 30 in valuation. So after evaluating all the points, the final score for Reliance is 75 out of possible 100. You can pause the video for a summary. This video is only for educational purposes, not to be taken as investment advice. Do your due diligence before taking any investment decisions. Leave a comment about which stock would you love to see video on next.